Welcome to Talk Tickers. Today, we're digging into the industrial supplier Fastenal, ticker FAST. And their latest earnings report was a real head-scratcher. We saw some really strong growth on the ground, but the market, it gave the stock a pretty cold shoulder. So let's break down what actually happened. All right, let's just dive right in. Look at this. On one hand, you've got daily sales up a very, very healthy 11.1% year over year. That's a clear sign of a business that's doing something right. But then you look at the other side, and the stock finished the day down more than 2.5%. So what gives? On the surface, these two numbers just don't seem to add up. And this is what we call a classic better business, worse headline situation. Operationally, it really looks like Fastenal is executing its plan. But the market's reaction? Well, it's telling a completely different story. So the big question we have to answer is, what did investors see that made them ignore that impressive sales growth? Okay, so here's where things start to get a little tricky. If you look at earnings per share, it came in at 26 cents. That's exactly what the street expected, so no big surprises there. But, and this is the important part, revenue, while it was up nicely from last year, actually missed the target by about $13 million. And, in this market, even a small miss on that top line is often enough to spook investors. So what did management have to say about all this? Well, their message on the earnings call was pretty clear. They basically said, look, we know the broader industrial economy is slow right now, but our strategy is working. They're not just sitting around waiting for things to get better. They're actively focused on taking business away from their competitors. And this is exactly how they're doing it. Check this out. Their digital footprint, which is really a mix of their on-site vending machines and e-commerce, now drives over 62% of their sales. Now, this isn't just another way to sell things, it's a real competitive advantage. It weaves Fastenal right into their customers' daily operations, which creates this incredibly sticky relationship. And it goes beyond just the tech. Their whole strategy is laser-focused on winning better, bigger business. They're seeing improved contract signings with large, strategic customers. Plus, they're finding these little pockets of strength in specific areas like transportation and data centers, which proves they can still find growth even when the rest of the manufacturing sector is kind of flat. Okay, so if the business is running so well, why did the stock sell off? Well, it really comes down to two big fears hanging over the entire sector: tariffs and demand. The market is worried that tariffs are pushing prices up, which might be creating this illusion of growth, while in reality, it's actually squeezing customer demand underneath the surface. And this chart right here adds some really important context. You see, Fastenal has actually been underperforming its peers. A 14% gain isn't bad on its own, but it's lagging the broader industrials index by a pretty wide margin. That kind of recent history creates a less patient group of investors, the kind who are much quicker to sell at the first hint of any bad news. So let's put all the pieces together. That small revenue miss, that was the trigger. But the real fuel for the sell-off was the 50 basis point drop in gross margin. Now, management said it was mostly due to timing issues, but the market read it as a clear sign of pricing pressure, and that fed right into that core fear that tariffs are starting to squeeze the business. Now, looking ahead to 2026, there are three key things you're going to want to watch. First, any easing of tariff pressures would be a huge tailwind for the company. Second, we need to see those gross margins stabilize to prove that this quarter's dip was just a temporary blip. And third, the company is spending more on capital expenditures, so the market is going to want to see a clear return on that new investment. Which brings us to the next call. For the first quarter of 2026, I'm expecting the momentum from those new contract wins to keep going, probably driving an inline or maybe a slight beat on EPS. Revenue, though, that's still going to be the battleground, and I'm predicting it'll come in very close to what Wall Street is expecting. And what that probably means is the stock is going to stay pretty range-bound until investors get a much clearer signal on the overall economy. So here's the bottom line. Fastenal is a high-quality company, and they're executing a very smart strategy. The problem is they're basically sailing directly into these big macroeconomic headwinds that are totally outside of their control. The business's strength is being canceled out by the weakness in the environment, and for that reason, our rating is market perform. We expect the stock to perform in line with the sector, but outperformance is going to be tough until that whole tariff and demand picture clears up.
This is not financial advice.